Hi, I'm Jonathan McDowall. I'm a financial planner with MHA Henderson Loggie Financial Planning. I'm often asked about inheritance tax, or IHT, and how it may affect an individual's assets and the money they leave to their family in the future. As with many other areas of tax, there are ways in which we can mitigate IHT and also some key considerations to be aware of. So in this video, I'm going to provide an overview of inheritance tax and the planning methods that can be considered to try and reduce inheritance tax liabilities. It's a tax that may affect individuals when their estate is above a certain value on death, or if they make certain gifts during their lifetime above a certain value. Each individual has a nil rate band, which is your exempt amount for inheritance tax, which is currently £325,000 per person. The nil rate band could be transferred between spouses, so on death we could then have a total nil rate band of £650,000 on sick and death. It's important to consider that assets passed between spouses are also exempt from IHT. One potential issue with the nil rate bands is that it has been frozen for many years now, but over those years we've had significant rises in asset prices, property prices, which could potentially then be an issue for individuals being liable to inheritance tax. A further nil rate band is also available in relation to your main residence. So as long as you leave your main property to your direct family, whether that be your children or grandchildren, a further exemption can be claimed. The current main residence nil rate band is £150,000 per person, and that will rise to £175,000 from April 2020. It's important to be aware that the main residence nil rate band could be reduced if your estate value exceeded £2 million. The main resident nil rate band is a complex area, and I would suggest that you seek professional advice to assess your position towards this. If your assets exceed the nil rate band, then inheritance tax is applied at a rate of 40%, so a significant tax hit that can be applied. There are 5 ways that I'm going to highlight that could be useful to help mitigate your inheritance tax liabilities. So although it sounds a bit strange to say from a financial advisor, but spending would be quite a simple way for you to reduce the value of your assets and estate and resulting inheritance tax liability. It's important to consider when we are spending is to spend it on something that's not a tangible asset. So for example, going on a nice holiday, if you were to buy an expensive car, well that's still going to be an asset in your estate. You need to be mindful though what you're spending, making sure it's within your means and making sure you've still got enough to last the remainder of your lifetime. Gifting is another option that I'd always recommend to consider, allowing you to gift assets or money directly to your beneficiaries and also allowing you to see them enjoy the benefit of these. There's a number of exemptions that you can consider when gifting that allow you to reduce your inheritance tax liabilities. Firstly, we have the annual exemption, which allows you to gift up to £3,000 in total per tax year. We also have the small gift exemption, allowing you to give up to £250 per person per year. In addition to this, we can make gifts in respect of marriage. We can gift up to £5,000, for example, to your children, up to £2,500 gifts to grandchildren, and up to £1,000 to other beneficiaries in respect of marriage. Gifts can be made to charities which are exempt, either during your lifetime or through your will. If you make any gifts that exceed your exemptions, these are regarded as a potentially exempt transfer. And what that means is you need to survive a period of 7 years from making the gift for that to be regarded as fully out with your estate for inheritance tax purposes. So trusts allow you to make a direct gift into trust, allowing you to remove that money from your estate, and providing you survive 7 years from the date of the gift, it would then be exempt from inheritance tax. A common use of trusts is for gifting money to children or grandchildren for them to benefit from that money in the future. When we place money in trusts, we would look to put it in an appropriate investment so the money can still grow. The advantage of this being that any growth received would be out with your estate once placed in the trust. There are various types of trusts available and different options on how that money can be accessed in the future. However, as this is a complex area, it's out with the scope of this video for today, and I'd recommend you seek professional advice if you wanted to discuss this further. Another solution available are investments that qualify for an exemption called business relief. Providing these investments are held for 2 years and at the date of death, they would then be exempt from inheritance tax. One of the benefits of these investments are they would still be your investments, allowing you to retain control and access to the money. However, these investments do come with significant risks and they wouldn't be appropriate for all individuals. Again, professional advice would be needed on this subject to assess the suitability of these types of investments. The final solution we could consider is arranging a whole of life assurance policy held in trust that would be in place to provide a capital sum on death that would cover the potential IHT liability. Potential benefit of this being that your beneficiaries wouldn't need to sell your other assets to pay the IHT bill. However, arranging a life assurance policy isn't going to reduce your inheritance tax bill, but just provide a means to pay that tax. Hopefully this video has provided a good overview of inheritance tax and potential considerations on how you can mitigate any liability that may exist. However, as you can see, it is a complex subject and there is a need for professional financial advice. So if this is an area of concern for you, please feel free to get in touch or leave a comment below. Thanks for watching.